How viable is it to combine classic dividend investing with the options wheel strategy? Welcome back to the channel, guys. Today we're talking about my options journey. For those of you that don't know, I put out a short about it, but there is this new thing I'm doing where I'm adding options to my dividend account, my Roth IRA. And so far, it's been going really, really interestingly. I'm not going to say well, because I'm definitely still learning, but I wanted to talk about this, talk about the trades that I'm making, and talk about how this could potentially, from what I understand, be a great way to make extra money on your stocks. Now, I am very, how should I put this? I'm aware of how risky options trading is. And from what I understand about the wheel strategy, it is the lowest risk option strategy that you can have, maybe besides leaps, but even leaps can be risky depending on what happens. So I'm going to go over the wheel strategy and how I'm using it, as well as the positions I currently have. And this is just going to be a part one of this series. When all these options expire, I will go over what made me money, what lost me money, if I'm going to continue using this strategy, what worked, what didn't, and so on and so forth. So I'm going to explain quickly the wheel option strategy. I'm not an expert by any means. I've only had 4 positions in options. And so I'm genuinely really curious to see how this pans out. So what I've done so far, I currently have 2 sell puts and 2 sell calls in my account. And so what happens is the wheel strategy and how it works. When you sell a put, that is you saying that you will purchase a stock for a given price. And the same thing with the calls, but inverse. If you're selling a call, you're saying that you will sell your shares for a given price. And I'm going to go into Robinhood and I'll explain it a little bit more in a way that you can see it. And I'll actually show you the stocks that I'm looking at trading right now, which has been fun. Where did I pull this from? SteadyOptions.com if you want to read more about this, but let's just jump straight into it. So as you can see, a lot of these aren't ones that I would necessarily use. They're just ones that I've heard that people use. And of course we have MPW on here, which is really risky. And I don't know if I'll continue to do it, but let's talk about it. So for MPW, I'm pulling this up and we'll check exactly what my position is. I know I have 2 sell calls because I own 200 shares of, let's see, I have 200 shares of MPW. I bought extra so I could trade options. So if I was to do sell a put, and the markets are closed right now, MPW has really, really high implied volatility, which means the premiums are more, and the premiums are what you make money on. And so my idea with this is if you were to own dividend stocks like MPW that you're going to hold for the long term, which I'm planning on doing, and it yields a certain percentage, you can make money by selling covered calls on the stock. And so it's not easy money. People, the way I heard it or had it explained to me, it's really not simple money. But we can see this next strike price is expiring in 3 days. So a put, meaning that I would buy. So if MPW falls below $4.5, $4.50, and I bought this or I sold this put option, I would make $14, and that'd be $14 made instantly. That premium goes directly into your account. But if in 3 days MPW, let's say the contract expires and I have to end up purchasing MPW, if MPW is at $4, then I would have lost money because I'm buying 100 shares at a 50-cent premium. I'm paying 50 cents more per share. And once you're in the option, you can't just change it. You can't just get out. There's different things called rolling your options. I don't know about that yet, to be honest. Like I said, I'm a beginner. So let me know in the comments what you think. But this is a very, very simple yet complicated way of selling your shares or kind of leveraging your shares to make more money. And so the positions that I have so far, I have an MPW call for April 19. So this is that day. It expires in 3 days, and I have a $5 call. So I have this call right here, which is, let me switch to call. I have this call right here. So if you were to do this now, you would make $3. When I did this, I made $9 because there was a full month. And so time adds higher risk. And so at one point, this was actually a losing trade for me because MPW went up to $5. And so I was going to have to purchase, or I was going to have to sell my 100 shares at $5 even. So if it was over $5, I would have lost money. It has since fallen down for some of the news. Now, the next one that I have that was definitely higher risk is currently out of the money, meaning that at this point, if it ended today, I would have to sell my shares at a loss. And I have a 450 call that expires May 10. So I have 24 days for MPW to go back below $4.50. Currently, it sits at $4.67. This one was much higher risk. It's out of the money now, and out of the money trades are always higher risk. This is where you really have to know what you're doing, because this trade could potentially lose my shares for a discount. Now, I've still made money on these shares because I bought them for $3.90, but I'm losing the ability. Like, let's say MPW stays at $5. When this strike price happens in 24 days, if it's at $5, I am selling my shares for $4.50. And so I'm losing 50 cents per share, which is a huge negative. You don't want to do that. But I have gained a premium, and I gained a nice premium for this one because it was higher risk. It had much higher delta, which is the risk percentage. And so I made almost $23 for this call. So while these are definitely higher risk options, the higher the risk, the higher the reward. And of course, sometimes you get burned with that. But let's talk about some puts. Let's talk about a less crazy stock. So Ford is the first one that I purchased, and it's been doing terribly. So I purchased this. I purchased a $13 put. So I said, and let's see, I bought it. It expires May 3. So I said right here, we had gone from $13 up to almost $13.50. I said, well, I'll buy shares at $13.50. Since then, the price has trailed down terribly, down to $12. So what's going to happen is I am going to buy 100 shares of Ford at $1 off each. So right now I'm currently down about $100, and they paid me $44 for my contract. So I'm down $65 roughly. And so that's kind of the poison with this, is if you own these stocks and you have to sell them, or if you don't own them, you can get burned on buying in. But my goal is to get better at this over time, to understand the charts a little bit more, earnings and stuff like that, and to track these stocks and hopefully do better in the long run. And I think that I will, because the key to this and the point of this video is if you own a number of these stocks. So what I'll do with the wheel strategy, if I have to buy Ford shares at $12 a share and I lose $1 every share, I'll be down $100. I will then write a covered call option. So let's check this out. I messed it up. Here we go. If I was to do the option I have now, I would make $86. And they're saying that there's a 53% chance of profit. So you still have over 50-50 odds, but that premium you collect would be $86 because you're going to multiply the bid price by 100. And so it is high risk, but you never know. I'm curious to see what would happen. But here's my plan. Here's how the wheel strategy works. Let's say I get called at $12 a share. I lose $100 because I have 100 shares and I'm selling them all for $1 less or for $1 more than they are worth currently. I will then switch this to a later date out. So let's go 45 days for Ford. I want to sell them for $13 so I don't lose any money. So I say, okay, I will sell them back for $13 if it gets to that point. So boom, you're going to round this to the right twice. Selling a call, not a put. That's important because now I own the shares. So now I'm going to make $25. So on top of the 44 that I already made, now I will make 25. And you can even go lower if you think the price of Ford is going to continue to fall, or higher if you think it's going to bounce back to 13. But here's the beauty of the wheel strategy with dividend stocks. If I'm using these for covered calls, then I will still collect the dividend as long as I own it through that X dividend date. So if I have 1,200 shares of Ford and I'm getting a 6% dividend, let's say I get a 6% dividend for 1 quarter, I'm getting that 6% on top of all of the premiums. So then I'm still making more money. And so this is really, really complicated, guys. I'll go through another example for you. It's tricky, and it took me weeks to understand. I mean, it's not that tricky. I can learn it in a couple weeks. You can too. But how I'm planning on doing this is just an interesting way to make some extra money. And what I love to do is research this stuff, understand it better, and try it out. Try different things, because to be honest, I get bored investing. So now let's go to the worst trade I've made so far with options. And I made this on a whim because I was feeling just like I want to do something. AT&T. I sold a put on AT&T because I don't own AT&T currently. And so it's been tanking. Down the last month, it's down almost 6%. So the put I sold for AT&T is $17. So I'm $1 off this one too. So I made this put, it was in April. I made it around here, 17. And I was like, oh, but look at this. The 3-month chart, even the 1-year chart, AT&T has been trailing up. So I figured it was a pullback. It'll bounce back up. And I still believe it might. They do have earnings coming up. And so I'm going to hold it through earnings, which again is a different kind of risk. But I thought it was going to bounce back up, kind of how the chart has been. And if not, it still may go back. But we did retest these new lows of sub 16 almost. So we are at a new low. I do think it will be bought back up. The dividend yield is 6.83%. So I'm going to do the exact same thing. So if we go to the trade options, let's check out what my put would be. We're going to sell a put. And I did May 3, I did April, 10 days. So I have 10 days for T to go back up. So that's not likely to happen. So the put that I sold would now make me $98 instead of it made me roughly $36, $37. So it would be worth a lot more now. Chance of profit, 54%. And the way they calculate this, they're not saying there's a 54% chance that T goes back to $17 a share. They're saying your chance of profit, they're removing the premium value that you have as well, which I hope makes sense. So if I have T and I'm betting that it goes down, let's say it goes down $1.50. I have already made $100 on this put. So I would only end up losing $50, not $150, because I get a $100 premium. And so that's how they're calculating it. And it's important to note that. So what I'm going to do, and of course, these are called cash secured puts. The reason they are safe is because you have to have the money to buy 100 shares of these companies in your account. And Fidelity is the account I've been using, and it will actually show you that, which is really important. It's your buying power, because if you tried to buy 20 of these different contracts, then you would end up really struggling to cover all of that money. And say you only had 1,000 and you're buying a contract for 1,600. If you lose and you have to buy shares, you're going to be negative $600, and you can't do that. So my plan, so I have 10 days. So we're going to go out 45 days. We'll go out an extra 35 days from when I buy T. And if I buy it for 17 and I want to sell a call for it at $17, then I would make $25, which would be good. It's less than I made this time. But if T continues to downtrend and I'm like, you know what, it's down to, let's say I buy it at 16, it drops to 15.5. I'll go, oh, you know what? I'll now buy it at 16.5 and I'll make $43 instead of $25. And so that's how it works. And the beauty of this as well is if you keep writing these calls, you can continue to collect dividend income on these stocks. And so it is really tricky. It's not easy to understand. Let me know if you guys know options. And if I said anything wrong, please let me know, because these are really, really complicated. But the beauty of the wheel strategy is you continue to collect premiums on stocks that you already own. Or if you don't own them and you have them at a discount, you can buy them at a discount, because you can say, I'll buy this many shares here for a put. And so that's what I'm planning on doing when I buy shares now. If I ever buy over 100 shares or something, I'm just going to write a put on it. And if it continues to trade sideways, I'll continue to collect premiums. And then if it drops from my buying price, I buy it. I can then write covered calls on it and vice versa. So I have changed my portfolio a little bit. I'm not doing anything major because a lot of the dividend stocks that I own that I want to trade on, I don't have 100 shares of, and it's too big of a position in my portfolio. Like, let's say I want to do Realty Income. It's $50 a share. You have to have $5,000 for one option contract. And I don't want to have too big of a percentage of my portfolio in just Realty Income. I want it diversified. So that's how I've been working on things. I've been having a lot of fun. And some of these stocks I think are interesting. They're not all dividend stocks. Some of them are stocks that just trade sideways. Sometimes they trend upward. but I'm really curious to see how this goes. Let me know what you guys think in the comments down below, and follow me for the part 2 of this where I talk about where I made and where I lost money. I'll see you guys in the next one.